Being labelled the Ernst and Young Strategic Business Risk Radar, looking specifically at the top 10 risks for the mining and metals industry, and to put as many of those that have been identified as we possibly can in the spotlight over the next 6 minutes is Adrian Macartney of Ernst and Young. Thanks so much, Adrian, for joining us this afternoon. Well, where we undoubtedly are looking at a changed financial landscape, it's hardly surprising that capital allocation ranks #1 here, with a significant focus on improving operational efficiency, reducing costs and improving liquidity as well. But as commodity prices rise and profit margins improve as well, has enough of a lesson been learnt by companies, in your opinion, to stay focused on this as a risk?
Well, I think it certainly has. We're seeing that you'll see in our report the shift around cost containment. It's still there. Costs is really there. Companies are really have had to sharpen themselves up around that. But the key decisions that companies are having to make now are around: do they expand through M&A, as they have done through 2005 through 8, or do they really focus back on developing themselves, going for organic growth, dusting off those plans, getting back into development or exploration? Well,
when we're looking at development, along with that strategic threat that's posed to companies in terms of where capital gets allocated, we've got skills shortages ranking second, working to limit expansion of supply. Have the job cuts as a result of the financial crisis already been absorbed back into the market?
Well, globally, that's the really amazing thing, is the speed with which the demand for jobs has come back. The Australian economy certainly really bounced back very, very quickly. Their mining sector, apart from, of course, the resource super profit tax issue, but the whole sector has come back. And the thing is with the mining sector right now is that these jobs are global jobs. People have got the ability to move around the world, to move from Australia to South Africa to Canada. They move where the projects are.
And with cost being that key focus, as you mentioned earlier, and cost management coming in as a #3 risk here, one would assume higher wages as an incentive, not exactly the kind of draw card companies can afford to use right now, right?
Yeah, and of course wage inflation, we've seen it here in South Africa, not just in the mining sector, but across the board. And that's a big issue for South Africa to remain competitive in the industry.
It's a fine balancing act to play, though, focusing on sustainable cost efficiencies on the one hand without compromising the company's strategic purpose and competitive advantage on the other. So how do you see companies working to navigate around this?
Well, I think the issue is first of all is looking at the cost of the organization, and particularly looking at the cost of their capital. It's about getting into the right projects right now. So what's happened is because, as you said right in the beginning, the financial landscape has changed. Companies simply cannot go out there, raise easy debt and go and make an acquisition. They really have to become quite selective about what they do, look at what it's going to cost them to deliver on it, and then move on from there.
What they do, but also, I mean, we've been hearing this week where we have put quite a focus on the African mining sector, focus on where they do it as well. This where resource nationalism has cropped up. Let's explore this, because it is becoming increasingly more evident on the continent.
Yeah, well, not just the continent, but globally. You know, what we're seeing is governments around the world who have had their coffers emptied somewhat through the global financial crisis are looking at mining and looking and seeing an opportunity with rising commodity prices to restock their coffers. The issue there, of course, is that we've seen rising withholding taxes, mandatory social and environmental obligations. The most prominent of these, of course, being the Australian issue of resource super profits tax. We've seen the new legislation in South Africa, and of course calls for nationalisation of the mines.
Exactly, and that getting many nervous, but where one can understand to a degree the kind of protectionist attitude that seems to have emerged in these countries. What exactly would would-be investors like to see when it comes to policy and regulation? Because emphasis seems to be placed more on clear communication. Is it as simple as that?
Well, absolutely, but I think it's clear communication about where government is going. I mean, I don't think anyone disputes that, you know, governments want to get the best possible deal for the citizens of their country to enjoy the benefits of the minerals. But the piece is that mining is a long-term game. We can't have the rules changing every 2 or 3 or 4 years. People are making investments. Mining is risky. You're putting a whole lot of money into an investment that is going to potentially pay off over 10 or 15 or 20 years. So what they need is, the mining companies need stability of the framework within which they've got to operate, and they're then able to model that and understand what that's going to do to their cash flows.
One would assume that this goes hand in hand with companies needing to maintain a social license, though, in order to operate.
Yeah, most definitely. And the social license we saw a couple of years ago, strong movement towards health and safety in the South African mining environment. But health, safety and environmental issues remain. It's not acceptable globally that a company frankly has a lot of deaths or injuries in its workforce.
Let's talk infrastructure access here. I mean, are we seeing more investments being made by companies themselves to mitigate against this risk in particular to a greater extent than if it were left completely to government to resolve?
Well, we're seeing companies investing in infrastructure. The tough part is that in the mining sector we do have this paradox of infrastructure that we like to call it, and that is that infrastructure typically is a lower risk, lower return asset as opposed to mining, which is a higher risk, higher return. So mining companies who do have to invest into infrastructure are having to balance the two so that they do provide the appropriate return to their investors. Infrastructure across Africa will remain an issue, whether that be power, water, access through road or rail links.
Well, if we take a look at access to secure energy, for one, I mean, we know that there's been some underinvestment in that energy sector in developing countries. But at the same time, we've got companies also raising tariffs. We've seen Zambia just this week increase its electricity tariffs, for one. And showing that they could be enticing more investment in its way, where private power investors see this investment as lucrative moving forward.
Yeah, sure. And the issue with that power is that we need enabling legislation in many jurisdictions to make that happen. Private companies can be efficient at providing power.
Well, on that note, let's leave it there. Thanks so much, Adrian, for joining us this afternoon.